numbers on Friday revealing that your first half pre-tax profit has narrowed to just under 3 billion Naira, but the company still sits in a loss position here. Run us through pressures that persist for Starcomms at the moment, where we know already declining ARPU levels was a big one in the first quarter.
You are correct. The declining ARPU on the voice mobile sector is one of the issues. But what's also interesting is that we have launched in December of 2009 a number of cities, 7 to be exact, which represents a large number of capex investments. And due to the new launch, the marketing activities to generate the revenues to compensate for the OPEX levels have not come in yet. And that's really traditional in any new city launches. That also contributed to some of the losses that you see, in addition to depreciation, as well as the fact that we continue to see some aggressive subsidies from the competitors, which forcing us to continue to participate in the mobile bottom of the pyramid sale activities, which is yielding or contributing to some of those losses. However, you have seen the change in the data ARPU and on the data revenues, which increased by almost 21% in the first half of 2010.
Well, are you happy with the rate at which you're closing the gap on your loss position right now? And what's your target when it comes to actually raking in profits?
Well, we will, when we come to visit you, and when we announce the Q3 results of 2010, we will come to you with some news that we are undertaking now that will help us yield a positive position, which I can't discuss the details of which today. But let me also say that we are in a debt consolidation position and debt repayment position in this year. If you recall, last year our focus was operational efficiencies, which we've done very well in. This year you will see from the results we have a 12% reduction in total debt. By year end, our net debt to EBITDA position will be well below 1.5 times, which is very healthy for a company that's in an aggressive expansion and growth mode. Now, in terms of losses, much of it is due to the expansion, which then yields depreciation on your books, and that is contributing to the bottom line loss. But if you look at above the line, we have actually turned positive in the last part of 2009. So from a dividends point of view, which is really where most of the pressure is on, or the PAT level, that will only be possible when the depreciation reduces, and that's some of the activities I've mentioned we will announce in Q3 2010.
Well, looking at some activities that you have been engaged in from an operational side of things, where, as you emphasized, focus has been over the recent past. You've had or you've subscribed to the main one undersea cable. What avenue do you see this opening up for the business moving forward, where we know data capability has become a strong focus?
Well, ICT penetration in any country is directly related to economic growth, and as Starcomms is the leader in the mobile broadband business in Nigeria and has been for the past 3 years, we have seen that the reduction in bandwidth cost has contributed quite a bit on the profitability side from an OPEX point of view and a margin point of view. But what's very interesting for the consumer is we have noticed a tremendous reduction in trouble reporting to the customer service center from the broadband performance point of view, because whilst we were using satellite for the access to the internet, which yielded the quality of the product less pleasing to the consumer. With Main One, we've seen a benefit on the pricing of bandwidth per meg reduced by almost 3.5 times as compared to last year in 2009. The performance, which is more interesting, has improved triple times for the consumer. So the performance is better, the price is reduced, the margins are improved, and that will help yield additional penetration in new cities and other locations for Nigeria.
Well, where we're talking about debt consolidation on the one hand, one of the big points of note is that has been that there's just too many companies operating within the CDMA market to actually leverage off this opportunity that heightened penetration could bring to you, and that's putting operators in general in a pretty deep crisis. Are you looking at industry consolidation on the cards at this stage?
That's a very good question. If you recall 2 years ago when we first went public, the first thing I said on the first interview with your good self on the Power Lunch with the CEO, that consolidation is key. The reason being is that you have too many players in both GSM and CDMA sector. Now, the CDMA players who recently received their Unified Access License are considered late entrants. Therefore, the growth and the imbalance of the number of subscribers for the GSMs versus the CDMA necessitates that we need to reach scale economies at a faster scale than those of the competitors in order to reduce the outflow of cash from an interconnect point of view to the GSM operators, as well as yielding scale economy for purchasing power. So that's really what I've been talking about from a consolidation point of view. Today you have seen really Starcomms continuing to be the most profitable company, and many of the other CDMA players are in fact in a serious situation. And if we do not facilitate consolidation, we will continue to see pressures in the market on the other CDMA players.
When it comes to economies of scale in-house, I mean, how are you working to enhance efficiencies and lower your operating costs there, where the question would be, are we looking at cutting fat off the business to bringing that, those cost pressures lower, or do you run the risk of actually cutting muscle?
Well, there's actually the fact that needs to be discussed from an operational perspective for a late entrant, especially in a market like Nigeria, which is highly competitive, has to do with operational efficiencies, number one. Number two has to do with the participation in profitable segments. And then number three, as you've seen from our results, we voluntarily churned unprofitable customers on our business, which is the first of its kind in this industry, where an operator actually sheds customers that are not contributing positively to the business. So the operational efficiencies continue to be having to manage your operational costs, which we've done very well. What we started to do in 2010 is outsourcing, looking at our infrastructure management processes, and reducing the overall purchasing of handsets, which is a key issue in the CDMA market. And we've done very, very well in all these three events. When we come back in Q3, we will be announcing a couple of events that I think will please the market from an operational efficiencies point of view.
Maher, how exactly do you shed customers? Could you explain that to us? And do you then not run the risk of, when an economy kicks in and when growth starts kicking in, that you have lost a handful of those who could well be big contributors to your bottom line?
Not necessarily. The voluntarily churn have to do with a targeted approach to finding the customers that you offer products and services to, and their contribution to your overall business performance. A lot of these customers, and especially due to the aggressive nature of the other competitors on the CDMA side and the subsidies they were offering, which is an unsustainable process, took these customers on and allows them to keep rotating between all of these operators on a 90-day basis, which basically says you're investing CapEx and OpEx in unprofitable customers. The way you shed those customers is if they're using your network purely to receive calls from flash, if they're like flashing their calling parties, you basically shed those customers and no longer provide them service, and basically not do any market activities directly towards them. Well, but at the same time, we are adding new customers in the mobile sector, as well as the fixed wireless, as well as the data. So we're not risking the growth sector, which we actually participate in.